Hey, greetings, Jonathan.
How's it going?
Hey, welcome. Let me turn that down a little bit. I can hear you really clearly. All right. Let's see if we can hear you, see you. Greetings. Happy Tuesday.
Hold on one second. Let me move my screen here.
It's always a little adjustment period.
There we go.
There you are. All right. Well, welcome to Tuesday's Macro to Micro Power Hour. I am very pleased to have Tuesday's guest of honor, Jonathan Gibbons of fintech.io, where I'm going to be hosting my indicators soon. Love your backdrop.
Yeah.
Looking very much at start of the new year and maybe a little bit of volatility coming into the markets. I am, by the way, Samantha of LaDuc, founder of LaDucTrading.com. And I wanted very much to kick off, actually, Jonathan, in kind of a follow-up to a webinar that I had on Thursday on those SPAC vehicles. I'm wondering, first and foremost, did you have a chance to listen in or have a look at what I had posted in regards to this subject?
Yeah, I got to listen to it on a kind of a follow-up. I didn't make it that day, but I was able to catch it on the webcast, and it was really very interesting.
All right. So I wanted to get your thoughts on this because I know that, this is a liquidity trade. It's been very hot. It continues to be very hot. I had mentioned that I had put together a list of SPACs from December 7th, and I kid you not, excuse me, December 7th, I just decided I would make kind of this list of these special purpose asset corporations, blank checks, if you will, to really start tracking them. And 194 in total. And if you notice, it literally is ridiculous. It's like less than 10% are in the red and not by very much. And the stuff that is in the green by very much. Anyway, just wanted to get your thoughts in regards to this conversation because it has a lot to do with our low interest rate environment, which is basically propelling this type of rotation. Market structure, there's tons of activity in the call buying in these names, at least the ones that have options, and the ones that are obviously kind of celebrity CEO status. Just wanted to get your thoughts on this. I thought it was a really interesting discussion. I was very lucky to be joined by a SPAC trader that I've known for a few years, also client, and San Diego Sam is his Twitter handle, but he is just tweeting about these and his trading in and out of them, but also a guest speaker who got Craig into it from Shandon, who basically came in after doing this stuff since 2003 and gave kind of the investment banker perspective. Anyway, I thought it was interesting. I've been asked a lot of follow-on questions about what it means, when this bubble is going to end, et cetera, et cetera. But because it was kind of a market structure and liquidity play, I wanted to know if you had any thoughts on it.
What's the 12-month returns look like for those? Right. I had read some interesting stuff after I watched it and was curious if there was any research on like 12-month, 6 and 12-month returns, not just like 2-3 month returns here in this past 90-day window, because a lot of them have been in the last 4 months max type deal, and they're picking up in steam right here. Do you have any on that?
I don't have returns. I have active SPACs and cash in trust, which is obviously exploded higher just in this year, from 25 billion to a lot more. And number of SPACs as well as deal volume. Right now, it's looking like 350 billion worth of total enterprise value, and this is a month old. So I don't have the return numbers. I did grab a whole bunch of stuff to kind of flesh this out after having the webinar and before, just to kind of feed my brain of how big this space was. But no, they also have a window, obviously, of getting these deals done before money's returned. But there's a lot of cash here that's waiting to do deals. And on the flip side, This is a play as long as interest rates remain extremely low. And that was the one chart that I actually grabbed. I don't know if you can see this, investment grade credit yield adjusted for inflation. First time in 30 years, it's been negative. So macro matters in regards to this speculative bubble phase, if they call it bubble, or euphoric phase in SPACs, as long as the risk-free rate of return is a better alternative. But no, I don't have deals done, rate of return.
So my thoughts are that this, if you take it back to like 14, 15, 16, you started to really see a pickup in M&A activity as people got really comfortable with the fact that they thought that interest rates would remain low. And even though you're doing M&A activity at a higher interest rate per se than buying hard assets like buildings, et cetera, if you're buying businesses that are doing 25% EBITDA, right, producing free cash flow, I can basically aggregate 10, 15 of those things with the interest rates as low as they are, use the free cash flow from them, pay them 4 times, 5 times earnings, right? And then, I've got a conglomerate, I've got something large. That was like, 15, 16, 17, 18, right? And that, that in and of itself is kind of an interesting thing, because we've had some knock-on effect from that, where small businesses were absorbed. We've lost really kind of a diversity of the marketplace, et cetera. So it's like kind of a natural phenomenon. And as you get greedier, right, then you start to see these SPACs, right, to start to play on, as we've gotten even more into this euphoric phase of the low interest rate environment. And it's interesting because I'm talking about interest rates with the little piece that I put together for the stagflation conversation. And this all kind of ties together. We're kind of towards the tail end of this interest rate, period, even though interest rates are going to stay lower, right, for longer, right? But the kind of the environment, the ecosystem, the economic ecosystem is not necessarily going to support this stuff into perpetuity. So I think that the SPACs create, like, if I'm doing an M&A deal, and this is just my business side of it, looking at it, if I'm doing M&A deals, I'm doing them to aggregate assets, right, and to become a larger company using the interest rate arbitrage to do so. And my risk is, it's whatever the spread is on my, EBITDA free cash flow to the interest rate that I'm borrowing at, that can support that as I continue to grow my enterprise value through that transaction play. This is not dissimilar, but a different kind of thing, where instead of me having to wait or do something very kind of complex to grow the enterprise value of the company, right? So, I got to go buy these companies, I'm aggregating or whatever. They can just take it straight public, right? And, the bid is just, it's flying high. So I wonder if the SPACs are more of a play at the moment, because bid is all on the buy side and they can get it public quick. They're liquid, they get into the market. So many more people have access to the market, right, than they had before. And so you have more people buying this stuff and they can bid it up quicker, and you don't have to do that stuff you were having to do even 4 or 5 years ago to create larger companies or even prepare yourself to go public. And so I think that, some of this is the mechanisms of the kind of the business cycle, and also the interest rate cycle kind of coming to where we're nearing kind of that total culmination. I think these are trades. I'm not sure about the longer term returns that I saw or just glanced at on this were negative. So like these things, it's hard for these things to hold some of the values that are created for them pretty quickly, right? That are coming. So they're like kind of like M&A IPOs real quick, right? Like, and they can get it into the marketplace. They're catching the euphoria. I think they're good, probably really good for trades. Now, I can't say that I have been trading. Now I got so much going on. I can't catch everything. But like I think that as long as they're a trade versus maybe a buy and hold, I think that they got to be sized up like that, because you're talking about being at the tail end of a cycle versus being at the front end of a cycle. Now they've been used for years, but they've not been used in the way that they're being used right now. right? Like the Chinese use them. Quote the Raven with the guy I was talking about last week, Chris. He's the one that was researching all those, and they were using those from China, companies that didn't exist. They get them listed via reverse merger, right? The blank check deal to go on the exchanges here in the United States. And that, I mean, the companies didn't even have any, they didn't exist at all. So they were used for a different purpose back there. So this legal maneuver, this kind of business structure slash getting to public real quick function. So that the mechanism, right, has been used for different things for several years. And now it's being used to get this stuff public real quick and get it in the hands, like kind of, it's hot, here, run with it. It's like SoFi. You know, SoFi would go on a road show. SoFi would do a lot of different things. SoFi would go, you know, pick a JPM or somebody like that to take them public. Whereas this happens like that, and they can get into the bidding war very quickly. So I think it's all about the euphoria and the bid for this space right now, which is why I think is justified by your data right there in their most recent data you're looking at in that TC2000 sheet you were looking at a second ago, where you had them all listed, where it would say that, yeah, these are really kind of being bid up very quickly. And maybe this is kind of a new thing that companies can get taken public, and the public access to companies doesn't go through the normal kind of JPM IPO process that it historically has. Maybe that is, maybe there's something to that. We don't know yet. I don't know that we know yet. I'd like to see if these perform like normal IPOs do, or are they going to kind of dance around? You know, I think it's kind of like the same thing that I'm going to talk about on the other side is, you know, are we experiencing something that we're calling a new regime, or is this like the tail end of a cycle, right? And the tail end of a cycle is not necessarily this week or next week. I just, the tail end of a cycle, and this getting these things out so quick to get the bid up is what I believe is more of the thing right now. It's like Chamath is doing 26 of them, one for every letter of the alphabet. I mean, even, you know, I get it, but like one for every letter of the alphabet, that kind of really would tell you how frothy it is, right? Like I'm going to do one for every letter of the alphabet, right? And so it's one, that's ambitious, but two, it seems to be that I would say, you know, is this, we don't know if it's great for returns, seems to be really good for short-term returns and trading returns at the moment. So nobody can knock that. But like, is it going to be something that over the next 3 to 5 years is something that's more normally utilized in the way that it is being utilized because of things like Robinhood? Or is it going to go back to, well, that was just another kind of PEVC play, right? A vehicle play to create a transaction, right? Build fees and then flip it to the public, cash out. I don't know. I think that is TBD, right? We need to see 2 to 3 years from now what the returns are for some of these things 2 to 3 years from now. And the one I really think is interesting is SoFi, because it's a good company. That looks like a really good company. And I think that kind of maybe, you know, where I'm on the fence of maybe this isn't just a flash in the pan. Maybe this is more of something that we see on a regular basis going forward, because that company is definitely a solid company. So it's not like just past the trash or some of this stuff. I'm sure some of this stuff is trash, right? Like there's no doubt, but 80-20 rule, maybe, I don't know. Like that would be my, you know, I watched it the other day. I was digesting. I liked it. I thought they had great comments. I think that I'm unsure, having experienced M&A and myself, and then, you know, over a 10-year period, and then seeing this and what's transpiring, it seems to me that this really seems like it's trying to get stuff to the public trade vehicles quicker, so that repricing can take place. And you know, gains are not 3, 4, 5, 7 years, right? They're 18 months, 16 months, 12 months, 4 months, right? Like,
well, they have to make the deal within 2 years, so there is kind of an expiration. But that comment that George made toward the end actually was that this is a new phenomenon that retail has glommed onto this, you know, speculative space with speculative fervor, with speculative call buying, you know, driving up the speculative valuations, because he's been involved in this since 2003. This has been an institutional product.
That's what I mean. It's a
fixed income.
Deal. Yeah.
but it kind of led me to news today. So one was the SPAC attack webinar, getting your feedback because of market structure and such. The euphoria around the single stock gamma option still fills my radar every single day. And then
on
today,
that note, hold thought right there.
Yep.
IPOE SoFi, huge volume.
Yes,
Huge volume.
So
huge volume.
Yes. So IPOE, you're talking about?
Mm-hmm.
Yeah. So IPOE is definitely the SPAC du jour, but Roblox today announced they're going to be doing their direct. What are your thoughts on that? I mean, that's going to be a target, right, for a SPAC.
I don't. We'll see what happens. Yeah.
Okay.
We'll see what happens. Yeah.
All right. So direct listing on NYSE. Any comments on that?
Yeah, I think it's a good move.
Okay.
Yeah, I mean, I know that I haven't seen it, so read me the article.
Literally, it just came out. Roblox, the company behind 150 million active users, has filed for a direct listing on NYSE. That's it.
Yeah, they're not going SPAC, right?
No, I mean, not yet, but
no. That's what I mean. Like that the SPAC stuff is it's a the deals are always like for a purpose when they do M&A and when they do for mergers, for acquisitions, for VCs going public. These things are all they choose a vehicle for purpose, right? And the Roblox going public on their own normally is for a purpose like that. They know what they're doing. So I think that they are looking at long-term value versus the quick flash in the pan. Those guys have been building that product for 2004, 5, something like that. So 16 years. So they're not concerned with the flip. You know what I mean? And I think that really bodes to being a long-term hold on something like that, right? Because you're going to be able to get that and hold it, right? And so, is it we go back to what we were talking about last week. Is this stuff a little bit too expensive right now? It's like Airbnb doubling before it even opened the first day, right? And being at $33 for their mezz financing 2 months before that. So 33, 63, 160 something dollars. And so, I mean, are you you're paying a big premium at the moment. So I would buy and hold Roblox. I mean, if you could get it at a price that's somewhat fair value, but there's no market structure on that yet, so you don't even have an idea. And that's the problem on these things too. It's like you don't know where fair value is because you have no idea of the trading structure. Because you can't see into their cap table and see what they did on their splits and all that kind of stuff ahead of time, unless you're really researching it. So.
Well, some definitely are. I thought maybe that was news that you could use, since we talked about that literally last week for game changers, right?
Yeah,
so when it becomes public, there's going to be, I would think, a race for for many retail to get into it, just like they saw Airbnb go crazy, right after that.
Yeah, and I can't, I don't think Airbnb is a bad, I don't think that's a bad buy and hold, right? A real long buy and hold, but you what price are you buying it at? With where we are right now, right? With the cycle, those are the things that I kick around in my head.
All right. Well, other things we're going to kick around today, a little bit on market structure. Anything that before we get into kind of the talk around stagflation, the backdrop, if you will, that I think we both agree is coming, and how to play it and all that jazz. But in the short duration, with inauguration tomorrow, VIX expiration in the morning, the Friday roll off of 50% of options on that last roll off on Friday. We did have a little peak to trough 2% drawdown on Friday, which wasn't dramatic, but it wasn't a surprise. And then we popped up like a daisy again on Monday. But anything for this week, we always like to kind of like look ahead at major events that might cause volatility. And I'm seeing the VIX expiration as one cause, and just basically a very coiled VIX chart. So what do you think we're looking at this week? Shortened holiday week.
Personally, right, like I was looking at it today. I retooled yesterday because we were off, right, with the markets being. I retooled and re-looked at all of the single stock options and really analyzed that. And I was looking at ETFs too. And when I was looking at that and kind of made sure that we were catching the top, let's say 150 of each ETFs and stocks, today you definitely saw, seeing as how those were readjusted in the platform. Today you saw almost 0.60 in the single stock call buying.
Okay.
And I was like, wow, I was not expecting that, because it came out real hot, a lot of calls in the morning, but couldn't really hold it during the course of the day. And I think that, and I'll talk about this kind of in the comments, because we talked last week about, we wanted to see what Yellen said. We wanted to see what some of these other people had said.
For the dollar. Yep.
Yeah, for the dollar and for some other stuff too, right? Because it really plays into kind of the longer term picture here. And I saw ETFs like, so SPY was really bearish today. Even in the midst of this, it was more put buying than call. IWM bearish. Qs are all about these earnings. So Qs were bid up, but Qs were pretty flat. So ETFs were, on the whole of the index ETFs were bearish again. And we were up towards 0.60, which is my threshold for the call buying being kind of busted. And we're still seeing massive call buying. It was just that the premiums for the calls, right, were lower than the premiums for the puts. So there were bigger orders placed on the put side than on the call side. And it was very, very visible today, as well as banks being like JPM. I posted JPM today. JPM had a nasty bunch of puts thrown out on that today, which is interesting because that's kind of towards the tail end. They've already done earnings and so forth. I think the VIX is making higher low. We're kind of settling in. I don't think there'll be anything to that inauguration tomorrow. I told friends privately, I didn't think Trump would be arrested or impeached. I think I'm still sticking to that. I don't think that either of them are going to happen. I think that they're just going to move on. What Yellen's comments, prepared stuff, and then today were more interesting to me than anything. And it kind of goes in line to what I had said before, that what are they going to do with their positioning? And she was talking about, social inequality, social wealth inequality, social justice. They were being she was playing hardball with China, saying that they're doing just like, I didn't know she was a diplomat. I thought she was a Treasury Secretary. So all this stuff was really, really to the forefront today. And then, so the inauguration probably be a nothing burger. Then, what does that setup look like? You got this bid in the VIX. You've got that holding on. You've got the single stock call buying rolled off on Friday. Didn't really get replaced today. It was seeing that's one day. It's still heavy. Everybody's still on the call buying side, but it was not. There was larger put orders. It's like Uber had a huge put order, right? Huge, just engulfed everything about the call orders for the day. I saw that. I have not seen that. That was the first time I've seen that stuff today. I don't know if it's meaningful, if it's going to stick. I would like to see the inauguration thing pass. Then we can get on with what, all these ramifications like cap gains and, a whole bunch of other stuff I talk about in a second. But what are these things?
She talked about that as well.
Of course she did. She threw it out there. She's
roll back the tax cuts, capital gains at some point.
Yep. I think we're going to charge everybody for all this, right? You're going to pay for it. So,
well, we talked about this a few weeks ago, right? The mantra has clearly been profits over people. We have a new regime, both political and fiscal. It looks like people over profits. At least that's the speak. Wouldn't be a bad thing, except short term, it will be painful.
Yes.
So, but yeah, she definitely had some comments.
That's my take on the VIX. My take on the VIX is you can show some of the stuff that you
no, literally, to me, it comes down to two things, which are I'm reaching here. Literally, I'm reaching, but I'm going to show them anyway, just for giggles. First, because my indicators have triggered nothing, right?
Yeah.
So we are on all three.
Oscillating. It's just oscillating. Yeah.
We exactly. So we're grinding. There's just nothing that's neutral to bearish as it relates to short, intermediate, or long term, or I should say chase, swing, or trend time frame. Yeah. However, I still have to look at this whole backdrop, right, of regime change and policies will dictate the economy. Economy at some point will show back up in the market, and then of course multiples. If we have contraction, earnings are coming out, guidance, that's going to be a nice tell. If we have interest rates continued, and I do believe they're going to continue higher, especially with a dollar spike, we could definitely have some volatility, but we've had absolutely no event whatsoever. I can draw a triangle on VIX, and it's worked before, and we're extremely, extremely coiled from this, high back in March to the, very quick, if you will, pullback. We had one in September, we had one in October, and we're right here again. So there's no question that we've got some potential drama and it could be volatile, but I'm still, and my stock bond volatility ratio, which I don't show except to clients, is absolutely on double support, ready to trigger, but it hasn't turned yet. So it's almost as if there's this congruence of timing events with VIX being coiled, with, and not just VIX expiration, because that happens every, third Wednesday, but with my stock bond volatility, with the dollar. And I grabbed this chart actually from Twitter because I liked it, which is where you can see where the dollar net futures long short, these are the ones that are very, very short, what happens next, right? They cover. Very, very short, they cover. Very, very short. And here we are again. So you and I are both looking for that impetus where we're going to actually have the dollar move higher and yields, and that will reprice some risk. I think I showed that also last week, just real quick. This was value over, yes, also momentum has come back in. This is the value trade. It has exploded higher. I still like this. I'm still on this kick of momentum growth to value. I think it can be tested, no question, but ultimately we still have this inflation expectations are driving commodity higher, even if inflation itself is not. And I'm looking for the dollar in particular. It's coming up. It's coming up. Hold on. Where the heck is it? We did this last time. Here it is. All right. So this is an old one, but you get the idea because we had a kind of a move this week. But on the 11th, we talked about this, right? It was basing. This is the dollar, and this is gold inverse. We both talked about this being a fake breakout in gold, very likely to have a fast failure, and it did. So dollar intonating higher, yields and the yield curve, bear steepening. I still think we can get some volatility, but I have contended not until after inauguration, and here we are. We're coming into it.
Yeah, I think that's spot on, and I think it's not an event like we saw an event with the climbing of the stairs a couple weeks ago, right? And that the event not necessarily a thing. Get to the inauguration, clears. We're through the inauguration tomorrow. Now it's policy, right, and fiscal and monetary, and what do those things mean across the board? And I think that is exactly what you're starting to see set up. Like you've seen the dollar, and the longer this has based, to me, the more that these now borderline cyclical to maybe secular, right? These are.
Yeah, we got a whole year though to figure that out.
Yeah, so like this is like really starting to like get long in the tooth.
This just started in Q4, and this was on target for starting in Q4, right? We've talked about this since we started this whole program. Right. It was going to happen in Q4. Oil was moving higher, yields were going to pop higher. We've been waiting for the dollar.
Yep.
Right.
And now we're weekly charts, right? Now we're looking at weekly charts that are holding significant time frames.
Yeah.
And are really holding market structure levels, like the dollar in the weekly chart is holding a very significant market structure level, and it's just been bid since it hit that level, and it hasn't stopped being bid on any drop. It gets bought. So I think that one of the interesting things to me is how does this play out kind of with the bigger picture of what she was talking about today, right? What she brought to the table today, and that goes into the value play. Because I think commodities are really going to come into the fold here. They've already been bid to an extent. So do you get a risk kind of move that the dollar spikes, risk reprices, you get some different changes, but then was that kind of it for the equities market? And now it's going to shift to the value structure market. Because if you look at, and I would have to kind of walk through the whole thing, but if you look at like XME, for example, big move, FCX, so Freeport, big moves, those moves need to be retraced. And those are big part of the values plays, right? The, Exxon, these types of things, like all the energy stuff, big moves, maybe they retrace a little bit and then could be outperforming the growth surely based on the stuff that's going on, you know, with the change in styles, right?
So I have first, Craig asked a question I don't want to forget, but I have a theory on this, which is that factor rotation that is very, very strong in the CTA and quant world is, you know, long growth and I should say momentum, and short the anti-momentum and the value. And once this started to pop up, right, with the Pfizer vaccine announcement, and then the blue wave results, this has not been easy for shorts. They've had to cover. I think short covering rallies, and I mean across the board, whether it be the commodities on the expectation of infrastructure, economically sensitive, or, you know, cyclical plays, also the just left for dead value plays, quote unquote, like the GameStop and the BlackBerry and all these that have been shooting up 50, 60, 70, 100%. They're not even a SPAC. They're real, you know, real brick and mortar, you know, things you can hold. They're things, not paper. The point is, a short covering rally can actually create a trend reversal, but it doesn't mean it's a secular trend. So I think short covering rally is what we experienced, you know, based on this inflation expectation that's driven also kind of the convenience, the timing. But I want this test and retest and test and retest, kind of like what's happened with the cannabis sector. That's done a really fabulous job of bottoming out and then popping an expectation of this result, right? And now this looks like a trend reversal, but it starts with short covering. To me, that's the whole play starts with short covering. But I don't know if to me, I just think we need actual inflation and wage inflation, not just the expectation of it, to really have legs. And the oil trade for this year, which I've also kind of intonated, I'm long biased, especially if public transport is going to be shunned and people are going to be driving their own cars more because it protects them from COVID potentially. I think there's just going to be a little bit more of this commodity trade and yield trade. Bonds do not look good to me, and as a result, you know, I'm not a gold bull, as you know. So I still think the whole thing is moving great. But yes, XME, XLE, and XLF, as far as those three key, you know, reflation trade sectors, they've all hit resistance. All they're double tops, basically. All three of those are at double tops, and in the past week and a half, they've been going sideways. They ran up into the bank earnings, and now they're kind of churning. They've retraced 100% on a fib level, you know, from the March low to a consolidation, and then they broke out, and now they're going sideways. So they're tired. They need some more reason to keep going.
Yeah, totally. Yeah, totally.
I think the short covering rally has been really what's helped and fuel this in large part.
Well, that goes to there's only two trades, a short vol trade and a long vol trade right now.
Talk about that.
Yeah. So my 2 cents is that, you know, effectively at this point, it's really similar to what you're describing, but maybe from a different perspective. So you've got everything rises simultaneously, right? And volatility does not, right? So everything goes up, right? From across the board, from SPACs to these GameStop, right? Plays, BlackBerry, you name it, just anything that is considered lower priced. Like, have you seen the penny stock volume?
Oh my gosh, yes. Yes.
Right. Okay. So basically, I'm just hunting for something that's, you know, considered lower price, and then it rises. All of that buying acts like short vol, right? Because it's a bid, right? Stock buybacks before that, short vol, right? ETFs, right, function good in a short vol environment, right? So basically, all this dip buying that's been functionally going on, it acts like short volatility. And then we get these bouts of volatility, right? Just straight up volatility where everything gets scorched at the same time.
Yep.
And this is like, you know, I'm not going to the Nirvana the doom loop cycle. This is like literally just really there's only two trades. When there is vol not occurring, right? Everything's going up. When there's vol occurring, right? And liquidity is like, ooh, then everything goes down. And I think that right now, right, the enemy, and Powell said this in 18, right there at the end, He said volatility is like effectively the enemy because of the pension system having to get 7.5% target, right? And they have to get that target and they don't have any yield structure. I didn't know this, and I did some research this weekend. 70% of pensions are in equities and 20% are in bonds. They've even gone further out than before to get that, right? And they're doing stuff like short vol targeting, et cetera.
So you said 80-20, not the 60-40.
Yeah, so 70-20-10. So they're in like
Oh,
cash.
70-10, okay.
Yeah, 70-20-10. And so it's like, that's just a disastrous situation, right? And that's really, I think, one of the drivers of all of this is that the pensions are so, the obligations are so drastic that they cannot afford volatility to whack those. So what did they buy in March? Or I think it was first part of April. What did he announce that they were just going to buy?
Oh, the zombie backstop, the HYGs and
Yep,
such.
literally, we're just going to buy it, okay? All the pensions are holding it. It's fine. We got it. We got all the stuff that's in the pensions. Don't worry about it, right? We got it covered, right? It's fine. We're going to buy that. That initiated everything that we've seen, and it's been going short vol, basically cheap to cheap to cheap to cheap to cheap. Whatever's considered cheap gets bought, right? And it just goes cycle to cycle to cycle to cycle. And that supports the passive structure, that supports everything. But the ETFs are like, got scorched when it went down too. Because so like everything that's happened in the past, let's say 40 years with interest rates declining, right? Really since 81, right? So it'd be, 40 years, right? Is driven all of the risk out to the curve. And I've mentioned this several times. So now effectively, we've got a situation where everything is really speculative at the very end because, and I'm just trying to put all my notes together here. And so it's either long vol, right, at one moment or the other, or you're short vol, and anything else is short vol. So there's really only two trades, and those things go up. And when the vol hits, everything else goes down, and vol goes up.
I call it the rotation trade.
Yeah, I mean, well, yeah, I mean, you're rotating from the cheap to cheap to cheap. I would say, yeah, I can see that, but going from long vol, right, to short vol, everything becomes short vol. The problem now being that they've got the change in the tenor. That's supportive when it's fine, when equities feel like they have liquidity, right? That works, right? And you can continue to play that game of musical chairs from sector to sector to sector to sector, stock to stock to stock.
They will.
Pensions are fine as long as there's perception of liquidity, right? And so what happens now with Yellen and all this socioeconomic conversation, it could be a complete secular change where it's not really about, they've got a significant problem. The wealth inequality is the greatest it's ever been in the history of the United States. And to continue to do these things that they're doing are going to cause some significant problems, which are a real big part of what happened last year. And so now they're looking at this going, maybe we're talking about it, maybe we're not. Maybe, they are saying stuff. Everybody's like, oh, they'll never raise interest rates again and all that. I buy all that. But we've got the debt to cover the direct fiscal payments is what, 2 trillion on top of, I think that number.
We're going to outgrow it. Didn't you hear?
6 trillion.
Inflated away.
So
Why we outgrow it?
So are we at the tail end? And I think everybody would then, and I wanted to bring something that actually people start really thinking about and munching on, because everybody's really euphoric right now. And you should continue to remain euphoric and keep playing these, this SPAC trades, everything until the music stops. You're doing very well. But is it at the very end that they have to change the way that they're going to continue to provide liquidity, right? Or the perception of liquidity, and where is that going to go? She says we can continue to do this big because we'll just keep interest rates low. But the debt burden itself becomes an issue. And if you look back to the 70s, the last time we had a structural financial change in the environment was in the 70s, and then in the 80s, it all reset and went a different direction. The 70s were the issue where we had stagflation. And stagflation by definition, right? And I pull up my definition: persistent high inflation combined with high unemployment, and then stagnation in demand in the country's economy, right? So we, right, have high employment, and it's consistent and persistent right now, right? We have inflation. We have inflation. I know people are saying we don't have inflation. Housing prices right now, right? When people were buying houses in the 80s, they were buying a house for $60,000, $70,000. that same house is selling for $600,000-700,000, right? Apartment rentals, vehicles. The moderate income house here in Florida is $315,000, up from $155,000, 10 years ago. That there is inflation, right? And the velocity of money, the banks, right, are not lending, right? So the banks aren't lending. All this kind of flows into you when you get in a stagflationary environment, and that really is going to draw down on multiples on earnings, right? And earnings are going to get hit in this environment. So I think
Well, you're talking about higher cost, which is that
Yep.
inflation, but there are different ways of measuring inflation. But yeah, I agree that the higher costs, including the $15 an hour wage limit federally, that's going to
that
be.
doesn't, as a business person, that doesn't work. What you do as a business person, having experienced when you're going to tell me I'm going to pay this person that, and I can't charge that to the customer, you find a different way to do that. That will happen all over the place. And you're going to get unemployment. You can't just pull these levers, right? And think it's going to rise, right? And they're going to get this inflation that they're thinking about. They already got inflation. They just don't have, the growth, right? That there's no growth.
What
Right.
I liked was today, actually, back to back in the morning, I'm kind of like, with my tea, looking at Twitter, what's coming up with interviews and analysis and such. And BlackRock's CEO says a leading investor is flagging. It's a really, really big whale in Asia, in fact, and it's speaking about right now the bond market is starting to say we're going to start seeing rising inflation. We're going to have a more robust economy in 6 to 12 months. So this cost, if you will, structure going up in the very same tweet that I was reading was Sheila Bair. I don't know if you remember who she is. She used to be FDIC chair. Okay. And she might be tapped by Biden to do something also in the administration, but I had just seen this. So we really have boxed ourselves in. Shift to fiscal support to help Main Street, but risk consumer price inflation. That's pretty much guaranteed.
Yep.
Guaranteed. That's already in play, which will make it more expensive for government to fund the very programs that Main Street needs.
Higher tax.
That's it in a nutshell.
Higher taxes come into corporations, squeeze them, right? The capital gains, squeeze them. I wonder how many Robinhood folks that showed their $25,000 a month gains have saved $7,500 of that to pay their IRS bill in April, right? Times 12. I would go so far as to take the under on that. All of these tax situations are very, very, very impactful at the corporate level and will absolutely shift stuff dramatically, right? And I also heard that was listening to some other stuff this weekend. It was just a really research weekend for me, trying to digest everything that we've seen, is that the Democrats have 2 years really before anything is at risk of holding control of all three branches. And so they're going to be very aggressive to push through their agendas for the taxation and everything else, MMT type structures, so have you. So the deficits will go in quickly. And she, whether that's good, bad, or indifferent, I don't care. But that's what's going to happen because they have to do it very quickly before they risk, the midterm situation with seats. So,
oh yeah, and typically the president has the political power or clout to get policies passed in the first 100 days.
And so it's going to be a gangbuster situation for the right after the inauguration, which everybody's thinking it's like Vol is maybe looking at, right, the Trump people showing up and, stop, because they've basically every city's got armed guards everywhere. What Vol's looking at is a change and the whole infrastructure of policy, which they're going to rush in. And what does that really look like and what could that do? And I think that is not priced in properly at all. I think that people are forest for the trees type situation, and they're not really taking into account that the liquidity. So volatility itself is really a mechanism of liquidity. Do people perceive the liquidity to be abundant or not? And we've got significant plumbing problems in the market as it relates to pensions and everything else. And so what does the Fed's stance change due to that Fed put perception. I call it the FPP, right? What does that do in the next few weeks? People are like, no, it's just never going to happen. It's never going to happen. The Treasury and the Fed, I called it the Fedgery, right? Back in April, May, right? It was, we just married the two terms because they were starting to marry. They're going to marry that, right? It's marrying itself. You got Yellen was the former president of the Fed, now the president of the Treasury. What is that policy? And the policy direction seems to be we're going socioeconomic. Is that still going to be the FPP?
And
right?
harder on Wall Street today. In fact, Rohit Chopra, he was formerly of the FTC. We talked about that a little bit. He was always the one who was talking monopolies need to be regulated. We need to push antitrust. Well, he got reassigned, and not to push him out. We don't know who's coming in to replace. There are actually now 3 positions on the FTC board, but he's now going to the CFPB, which is the Consumer Finance Protection Board, which is focused very much on Wall Street abuses. And he's are they going to do anything about that?
FPP, because guess what doesn't work anymore? None of these things work. SPACs don't work. Option buying doesn't work. ETFs don't work. ETFs, 270 plus Invesco ETFs. BlackRock had iShares. There's like, I think 190 plus. Yeah, I was looking at this weekend. These things, those one-time frame things that haven't transitioned to those hybrids yet, right? That we were talking about as it relates to like, active, passive, some sort of blend of that. So the entire guard is sitting on the premise that it's FPP. You can just buy the dip, which is the short vol trade always works, right? And here we have a change in the dynamic of I'm going to say a potential change in the dynamic of the Fed put perception. And if that comes through, vol will scorch everything. And I think the response to that is full-blown monetization of Fed debt. So, MMT, like complete MMT, a formalized marriage of the Fed and the Treasury.
Ugh.
And that is where you'll see massive runaway inflation. Where gold. So if I look at XME right,
then it's a time to buy gold. Oh,
correct.
Oh, God,
And so I think, is there gold has been significantly underperforming compared to like even the mining stocks comparative to Freeport, like
laggards.
Super way bit. But if that all comes back, if you look at the weekly charts of all those, if they all come back, gold comes back. Gold's like got that, the TNA stuff. I'm not a huge TNA guy, from
flows, and we've already proven that they match up beautifully.
But the cup and handle setup, right? I say this, the cup and handle setup on gold is astronomical.
Yes,
right?
it is.
Potentially, right? The setup in silver would be astronomical.
Yep.
All of the underlying commodities.
But when does that trigger? I mean, it's going to be
I
a
think
while.
it triggers after you get the is the Fed put, kind of this shaking of that situation, which could be at any point in the next, let's say 2 months, right? Because these policies all have to go in 100 days. What is is the market ready for these policies, right? Is the market ready for the Fed put to be pulled off the table? And they have said in the last 2 weeks, 6 different times that asset purchases could be tapered sooner. And it's just gone underneath the radar. And I'm like, well, typically that would be like, and they've 2022.
I don't believe that. I don't believe them either.
Right. But it's never, there's never going to be a pullback in it. They can't. But what they're doing is changing who's going to take care of whom. And the FPP, the Fed put perception, is the key to the entire infrastructure of all these different rotational gambits.
Are you saying it's a confidence game? All right, so that's the perception, and then there's reality that folks are still getting worried about rising inflation, and with rising yields and the whole cost structure, if you will. the dollar might be allowed also to strengthen, which is de facto tightening. We don't know what tools are in the toolbox with Yellen just yet, but there is a question here just in regards to the VIX of late. Craig asks, is there any significance to the fact that OPEX between January and February is 5 weeks this cycle? Is this kind of like, I think, delaying the expression of VIX being set free a little bit? In other words,
Oh, okay.
you know,
Okay.
that's
Okay.
I'm putting words there, but rather than the typical 4 weeks, in other words, is this, you know, both for regular options and for VIX, is there any significance in that cycle when that occurs in your experience?
Not really. Like, I think that it really lines up with the holidays, right? So it does play, right? But it, you know, you saw last year, right, something similar, but it wasn't until the following month, right, that it actually, you know, you saw it manifest itself. So you saw the peak in January, kind of a drawdown, another peak in February, and then it let go. And all that time it was building up some steam. This is
All right.
right.
That would be something to look for, because I will be
Correct.
looking for that divergence. I saw it in January, February. I
Right.
haven't seen anything yet. So you're
Right.
saying we could have one more euphoric kind of,
Yeah, well,
and
yeah,
then the
that's exactly what I'm
divergence
saying.
kicks in.
I'm saying you have to look at the 35.50 level in the SPY, and is that like, you know, because this dip buying, this short vol mentality, the habits that have been created aren't going to just die, right? Because no one, right, believes it. Even you're like, no, it's not. They're not gonna.
The tapering, nah.
Right. So like, so no one believes it, right? So you buy the dip. Buy the dip, buy the dip, buy the dip, buy the dip. Short vol, right? Effectively, that's what everybody should say when they say, I'm going to buy the dip. I'm shorting vol, right? And so when they get to that 35.50 level, you know, that's that first big fair value kind of level that was between the 3,300 level and the 3,800 level where we are right now. It's just a straight middle line, but it's actually a market structure level. That would be kind of where I would say, okay, where are we at? Are we done? Right? And your stuff will trigger everything from a market structure would trigger, or is there going to be one more attempt at high on totally just gross kind of insides, right? The insides of the market are turning off. So I think that, you know, but this is a different dynamic. I hate to look back to January of last year and February of last year and go, it's going to be the same. The holidays do matter. The Santa rally does matter. People in the first 15 days, nobody even came back to work, right? A lot of places until this week because they took, you know, an extra 2 weeks off. You saw a lot of people still traveling and stuff like that. They don't come back to the 15th. You know, a lot of people work around the world. They're like, I'm not coming back until after the 15th, until after the Martin Luther King holiday is over, because that's a national holiday in the US. So people don't come back. So now people are back at their desks. Let's just say everybody's back. So this 5 week period will be much more traded, digested, active, like you saw today, like the gamma rolled off, the 0.60. So you're seeing from a market structure standpoint, you're seeing a lot different action than you saw just even last week. That now will get traded out. We got to see some divergences of some kind, but you could see a spike and then a comeback and then, you know, still holding the higher level and go. I actually see a bid in the VIX still. Our flows are still positive, been positive and still remain positive since the 1st of December. I can't explain that on VXX environment, even though, I mean, as we sit down here, so it's very similar to what you're looking at on those kind of coiling charts. The undersides of the flows are still looking positive too.
Yeah, there was a very large order that came in today for June 30 by 40 call spread in VIX. It was, I mean, I'm still, and it was very large, 30,000 contracts, you know, for that spread. But I keep seeing some flow, but I don't have the cumulative like you do.
Yeah. So I think that's what we see right now. That's what I see is that I'm not seeing anything that would like totally. I think this could be like a quick thing that pulls back and comes back up and takes one more stab at 3,900, 4,000 level, or it could be, or this, I mean, or we're watching, you know, kind of the final throws at this stuff up here, and it may be just a little bit different, because if you look back to 2000, it never, there was some divergence, it's just a different environment. This is such a different environment than it was then, and this is such a different environment it was last year. And you got to take every environment each in their own. I'm watching the 3,500 level, 3,550, and then I'm watching the 3,300 level. if the 35.50 level were to hold, and right now we're not even talking about any type of pullback, right? And I don't think there will be anything until after it's proven that these people do take office, right? Because there's still a little bit of something happen tomorrow. I don't see that. I don't think anything happens tomorrow. He's going to take office. Then it's all about policy. Then you could see some quick digestion and repositioning based on that policy, especially with VIX rolling off and changing and going to the new contract tomorrow. That then gives you a 30-day window, which is, as you point out, 5 weeks. What happens in there? And then do we go a little bit higher, or do we revisit that 35.50 level? Because I didn't, is IWM was really ugly today from puts too. Lots of puts. A lot of puts. Just like, I was like, wow, it was like 4.12 or something like that the last time I looked before the end of the day. And which is interesting considering, and these are the larger orders were in the puts versus the calls. So it wasn't skewed. It was just legitimately more premium. They're buying above ask and everything else. A lot of the unusual orders were
interesting.
So that was into the strength, right? And so, I think that you got to see some days, many days of that to formulate any kind of like, hey, it's going to crack type situation.
Yeah, I have some other tells, and I'll just share them real quick, and then I want to answer Peter's, or not attempt to answer Peter's question. So just from a perspective of, the FANG stocks have such a sentiment, but also a weighting, in the major indices. This is just from that, March, April bottom all the way to now. This is from last week, but still same difference, right? The 15th, we're in this area. We have not broken. It's actually 3 levels of support. But if we were to break risk off in Apple below this 125, same idea. Microsoft has also petered out. How many months now? Since basically June, right? This is now tagging the underside of the trend line. Are we going to roll over? Again, it could be just a continuation pattern in the making. This is digestion, but of course we're looking at the risks. So head and shoulder potential in Google. This is on a weekly, by the way. I probably should mention that. Hasn't come down. This again could bounce and move higher, but I'm still watching since this is actually the strongest of the FANG stocks. It broke out and has been going sideways since October. Can't help but watch to see how it kind of handles. Amazon has already failed the trend line, just grinding sideways, not higher. I keep looking at these kinds of stocks going, okay, they're obviously tired, but sponsors are still there. The VIX is coiling, but it hasn't triggered. This is still, to be determined, and everyone's kind of just waiting, like you said, to make sure that the inauguration goes off smoothly. And the expectations. Peter's question, how do you measure the impact of COVID, which, by the way, is worse? UK here, the strains, the ICU, the deaths, the cases, the lockdowns, it's worse. So it's not getting better. People just have learned to live with it. Those who aren't, impacted traumatically because of physical or financial reasons. But how do you measure the impact of COVID, an intensifying mess, on the ability of the Biden administration to focus on tax policy? Like all of these things that we're talking about are assuming we're all back to normal. The vaccine rainbow has been rolled out and they're moving forward without consideration. Do you think there's any pause in the administration's policy change that we expect just because of COVID, when we know historically the first 20 days are when they push through the most policy action historically in any presidential, regime change? If they're, not bipartisan, they gotta use their political capital, get what they can out in the first 100 days, because then not a lot usually they don't have much left.
Yeah, I don't see any change to the policies of redistribution at all.
Okay, so you don't see tax hikes, you don't see tax rollbacks of the top cuts?
Yeah, I think they're going to come after for everything as quick as they can.
Well, then what do you mean by redistribution?
Yeah, so capital gains tax, right? We're going to, instead of it being X, we're going to take it up. I think anything like that, that's redistributive, right? So that's like, you've been taxed once, I'm making money, I'm going to taxed on it again at a higher rate. Corporate taxes, roll them back, right? Going to just suck those right out and hand them right back, because most of the companies that, so banks, for example, only loan in over 10 million, right? The business is doing over 10 million in revenue. That whole Main Street lending facility was a total bust. Everything that I've talked to from private bankers, they're loaning zero to anybody that's doing under 10 million and loaning anything to anybody over 10 million because that's getting backed. So all those companies are sitting on just, they did fantastic. And during COVID, they just literally cleaned house as everybody's losing their house. And so, they're going to go hand it back, and they can frame it and that you should do your part deal. I mean, they can frame it however they want to. I think you're going to see more aggressive taxation. Did you see that Elizabeth Warren's team, all those folks from that redistribution group are on all of the committees working with Yellen? And I saw that today, and there was so many names, I couldn't even keep up with whom and where they were sitting.
But talk is cheap, right? And Yellen's coming out and saying the Biden, and she said it, the Biden administration is going to favor Main Street over Wall Street. I mean, she pronounced this whole, transition. VIX didn't move. It can't move. The eyeball supply, I know.
You gotta get through the expiration, and then you gotta confirmed that there's no kind of mess tomorrow, right? And people, as much as they're there's going to be a mess, or people are like, oh, there's nothing to be anything. I don't think there's going to be anything. I think they're just going to take off, but you still have to trade that, right? So I still have to hold something back. It's like, even me, I was like, I'm not going to get cowboy anyway here, because there's no, let's just see what happens tomorrow, right? And once that clears, though, the deck's set, okay, here we go, right? So now it's all about what it always is about, which is why I say that COVID's irrelevant, right? And I don't mean to downplay COVID. COVID was firing at all cylinders in June, and that was like when we were crazy action, right? And it's all about policy, right? That was both levers, fiscal and monetary, going at the same time. Come here, it's all about policy. None of this stuff related to the markets are anything else except policy and perceptions of what's going to take place with the policies and liquidity, right? And so what's going to happen with liquidity? And then, a bigger theme for the year, and I would add this in tax.
You said policies, perception, liquidity. Those are your three hot buttons.
Yes. And we are definitely, you're making hot money right now trading. Everybody's making hot money trading from these speculative type things. It's never, right, the fervor, it's the policy change, right? Like Greenspan stopped it, right? They stopped. It's been the Fed the last 3 times that you got a nirvana and then stop, and that's always what stops us. You got to keep an eye on that here as kind of an 8 ball as to what would finally maybe terminate the underlying short vol bid, and that would be totally kind of catching everybody off guard.
But you'd think they'd be front running this a little bit. They must have believed, like Peter points out, that they're waiting for COVID to get a little bit better under control, get more bipartisan support, and yet
I don't think COVID's getting under control. I don't think it even remotely is going to get under control.
And I don't think they're going to remotely get bipartisan support. So
at all. So this is going to be an ongoing thing. That goes into my STAGFLATION conversation. I mean, I had a bunch of notes on it, but just to consolidate, unemployment is not necessarily tied to the economic. I've got me and Laura have been shocked this week with 3 friends, gainfully employed, furloughed, right after first of the year. These are people, college educated people. Yep, now they're home, right? Because after the first of the year, that's what you do.
Yep.
Okay, you guys are gone. And they come back, and we were like, whoa, and they just had kids. And this is like a phenomenon. It's going to be slower in the numbers. It's all COVID related. That's not like just balance sheets. It's balance sheet related. It's COVID related. Yep, can't open back up. So I think that, thinking that everything's going to reopen. Vanderbilt University, the men's basketball team canceled the rest of the season last night. We're just not playing. You cancel the season, right? These things are going to continue to persist even with the vaccination. The vaccination sort.
Oh yeah.
I think the unemployment situation isn't anybody's real per se fault. Like even economic or the Fed or the Treasury, or they are all trying to solve this stuff. They really don't want this to be the case. People aren't employed. They can't work, can't pay taxes. I don't think anybody is looking for that. But the COVID thing is more impacting unemployment, and then creating the bigger situation about the wealth divide that I think, threatens things from a really, really big picture more than anything, right? So they could potentially change gears And I don't think you're seeing anything from the position of the market yet, but this is something they have to address. Inequality created during COVID
I think they want to address it.
is like just unbelievable inequality, right?
The job
It's like a
losses from
battle.
last month were 100% women. And it was luxury services, business, and also childcare responsibilities. 100%, not 90, 100% female job
These
loss
are
for December.
unbelievable numbers,
So
right?
they have to, but they also want to, and that's what's news. All right, so I know I hate to, summarize stagflation, but your notes on stagflation and commodities. You mentioned, of course, digesting this tremendous run, which
Yep.
has been, born on the back of inflation expectations, yield pop, Biden bid, short covering rally. We got all kinds of reasons, right? And the whole just cyclical, secular debate aside,
Right.
value is finally having its day. What do you see for stagflation backdrop as tailwind or headwind for the commodity trade?
That is completely a tailwind. In my
and any commodities in particular, because they're not all created equal, as it relates to precious metals, industrial, et cetera, et cetera, et cetera.
I think you just could see some very interesting ag stuff, right? Wheat has been,
Corn, yep.
go back to, like I put this here, energy supply and demand becomes distorted when prices change and the expense ratios change on all this stuff. And it's never that commodities by default are deflationary over time. If you look at any chart, you can just see that. But these periods where there's some plumbing problems or a mechanism problem within the economy that cause these things to spike. And that is typically seen in these kind of stagflationary environments or really inflationary environments. And I think that this is one of those environments. And oil, of all things, oil definitely could come back into play because it's manipulated from a supply and demand situation. And everybody's been on the EV thing. It's all going to happen, all this stuff, right? Just we're not there yet, though. Like we're not to where everybody's pricing everything yet. Now, and this goes to your kind of, we bring it back and it stays in a secular decline, right? But it gets this really cyclical move, right? That's inflationary and all these things. And I think that, all the ag stuff, you could see stuff in sugar, you could see any of these types of things. But I think that the silver for me is a huge opportunity trade. That could be on the lookout. And I haven't traded silver since 19. I didn't even trade it in 20. And I traded it in 19 and would trade it again this year, looking for it again this year. I think that gold is a trade. I think that Bitcoin is in this conversation if the tether thing gets sorted out. If the tether thing doesn't get sorted out, it doesn't live in the inflation conversation.
Because it's based in US dollars?
Tether is, there's some significant concerns. Colorado Travis Kimmel.
Yeah.
Check. Yeah. He's broken it down. I'm not even going to try to explain it, but like Bitcoin.
He likes complex puzzles.
Bitcoin could be a zero, right? Based on the tether problems, which is like kind of Bitcoin's thing. Is it's either a huge thing or it's a zero. And that is different than Ethereum. That's why I say Ethereum's a different trade, right? And you're seeing that price action this week. Right?
Oh, Ethereum's been great for a few weeks.
So when you look at this, like I think that the energy space, right? I think that the metals like PIX, right, and Axis stuff. I do think Freeport. I think copper. I think all these things that are kind of industrial complex components. You can't really trade some of the stuff like concrete and gasoline and these different things. These things could see significant inflation like they did when they put in infrastructure stuff. So we're going to put it fiscal stuff going straight into the economy. Those things spike, all kind of stuff. This is not anything about those things becoming more valuable. It's just there's not enough of them. The scarcity issue comes in with enough money chasing them that drives up the price.
Yeah, that would apply for uranium too.
Absolutely. Uranium is another one that could be in the same boat. So I'm looking at the commodities trade being the trade, if this shakes out this way, where you get them all kind of come back in their charts, and their chart structures look like that. So if you look at XME went from 5, or Freeport went from like 5 to 30. If you look at it on a weekly, right, and it comes way back down to like, let's say 20, right? Something like that. I pull it up and look at it. While I'm talking about it, I should do that, right? Pull up FCX real quick.
Yeah, it's unbelievable.
Yeah, so take a look at that and you look, okay, that comes back down. I got a level on my screen, $15 to $17, right? So let's say there's a market structure level at $19 and the pivots are running up underneath it around $15, $17 and a tag up at 34.
Hold on. You didn't share your screen, so I will just forget.
Oh, okay.
Okay, go ahead.
All right.
I mean, this is, by the way, from the March low. Can you see that return?
Yeah. So yeah, look at that. So that around the 18, go to the weekly view. Right?
I'm on weekly. This is my weekly view.
Zoom out a little bit.
It's 475%.
Here, let me share my.
That's on a weekly.
Yeah, let me share my screen. I'll show you.
Okay.
All right, so this is FCX going back to 15, right? And so this move right here, this is staggering move, right? 430%.
475.
I'm just rough grabbing it real quick. So you look at the flows on this thing. This is significant on a weekly basis.
Yeah,
this is not going away. This comes back. So this is that first strike. Pow. We know that things are going to significantly change. This all started back in March, but really crossed over in the summertime and really took off right around the election time, right before the election time, and it's made a bulk of its moves since the election time. This thing comes back, right? If you had a bout of risk off, right, and you got the VIX and you got the dollar and you got the spike, that wouldn't change anything about how bullish this is. And if it came back in here and held into $18, right? Let's say 15, 16, anywhere between 16 and 20 on a weekly basis, this thing would be ragingly bullish, especially with the profile volume sitting underneath it. I could give you 15 examples like this, XME, the metals are not, but the metals front run this whole thing. The metals were already running about a year ahead of all this stuff back in 19. They made it out, even gold made it all the way back up to where it was in 12. This has not made it back to where it was in 12 yet. Look at that. It was up around, $45, right? When back in 11 and 12. So I think that if you do get the risk on situation, you do get this change and you get stagflation, all of a sudden you have all these things come back in, and it's not a trade of like they're worth more now. It's a trade of the fact that the price of all these things is now significantly going to be higher because the things that they're deriving are going to be more. Everything in this space could become attractive. And yeah, I don't think I wouldn't trade this here. I would trade it right there at $18 all day if it got back there. And people would be like, oh, that's done, and it got killed. I think that would be on a long-term perspective. That really lines up with the MMT, right, where they have no choice, which is your point. They can't let interest rates rise. They have to monetize, right? But they can't just go do that right here. They're not going to do that right here. They'll do that at the next kind of volatility spike situation.
Or a dollar spike.
Correct. Which they could coincide, right? But you see that if I look at UUP right now, right, and I really zoom out on that one, right? This is sitting right there at that bucket, right there on the.
Yeah, nice place for
right. And then all the flows have turned back and they're positive now, right? And then the momentum's picking up, and this is going to get out here. This 26 level right here coincides with everything that looks at on that XME, and you look at on Freeport. You look at 145 to 162 on GLD. You look at 16 to $20 on SLV. All those things coincide. This also coincides with a SPY level at 30. Let's say 3,000 to 3,300.
3,300. Yep.
Down to 2,800. Even down to 2,800 in the ES contract. This all would still be the same conversation, right? And so I'm very curious to see, and you look at, this is the weekly, that's the weekly so far for UUP going into this week. So I haven't registered it for this week yet, but I think that this kind of jives out for that stagflationary environment where commodities are the trade. And I think, you know, to the Bitcoin crowd, if the Tether thing is sorted through, it's definitely an inflationary trade too, right? It's about preservation of the purchasing power. But you know, that's TBD, right? So those now you know start pulling apart these different trades and seeing what they really mean. And if you get a cyclical change that could potentially be a secular change as far as the growth stock stuff is concerned, and the redistribution thing, now you've got a whole different ball of wax. I don't think anybody can tackle that question until you get to these levels here on all these charts, right? Just from a chart perspective and a market structure perspective, all that is what they call conjecture, right? Until we get there. When do they react? How do they react with policy at these levels? But I think these levels are coming, right? I think these levels are coming in the next 90 days.
90. So I have the same theory, right? That this is going to be, the timing is perfect for a dollar bounce with Yellen coming in, talking up the dollar. It's de facto tightening. We have all of the reflation trades at resistance after a phenomenal run. And you know, but 90 days, I think that's ambitious. Are you timing 90 days because of the, you know, 100-day presidential power, if you will, that's historically where the most gets done policy wise, and the market's gonna have to quickly, by the way, it's also earnings season, so it's really important guidance moving forward. So you really think this is all going to get retested in the next basically month?
Yes. Well, no, I wouldn't say in the next month. Like,
well, it starts
in the next 90 days, somewhere in this window, you're going to see that could be next month starting, or, you know, we still don't see the divergence, but you can begin to see it even here, right? Like XME, like it hit that level you were talking about.
Yep.
At XLF, it hit the same type of level, right? Right. These are all hitting significantly higher areas. This is higher now, right? And it's peaked out, right? And it's, you know, through that candle, and it's rolling over this week. You know, I think that you can't say next week or the week after, or whatever. And you don't want to say that these things, you know, after they run up through and got out of what I call just the swimming pool, these are all out of the swimming pool. Everything's out of the swimming pool down here, right? They were drowning. They're back out of, they're over VWAP. They're over the pivots. They're over all the moving averages. These are all strong. They're over the volume points of control. So, you know, when it comes back to test all this, that's where I think we find out what we're dealing with. Are we dealing with something cyclical, or are we dealing with something secular? And I think that really is my play. I think
way of putting it.
I think the commodities are the best trade if it's a secular thing. And I think, you know, you could get one more even, you know, higher run, but I don't think it would take, you know, all the kind of the Johnny come lately stuff that's buying calls. You get down to 3,300. If you look at SPY, and you dump SPY down to, let's just say this level right here.
Yep.
On an 11 or 12% move, I think you're going to wipe out a great handful of people. As crazy as that sounds, a lot of people, you know, the small lot stuff that's way leveraged up, that, you know,
I don't know. It seems like the gamification, the term that you use, is a really good one, and they're going to chase in either direction. They're going to shoot first and ask questions later.
After you know, you get, you know, buy the dip, like, you know, buying calls, right? Flipping to buying puts is so much different than buying calls, right? With the way that puts are structured, right?
Okay.
They react. So I'm not sure that that's the first move. I think that it could be a thinning thing where the smartest traders of the bunch pick up how to do that pretty quickly, and the bulk of them, 80-20 deal. I think 20% of them pick it up, and I think 80% of them get wiped. And this area right here on just a simple 10% move would be, you know, interesting to see the dynamics that unfold with that. I think that this level, the 32.80, 33.50 level, coincides with the dollar level, coincides with the comeback level in XME, coincides with a bunch of the different levels for GDX and a bunch of other things. And you find out whether we're dealing with something, like I said, that's, you know, are we going to go higher, right? Or are we going to be kind of done at this point in equities, and that total secular shift starts to take place? We don't know any of that. You don't know. And I brought up the pension stuff earlier, and I mentioned vol, and he had asked about the 5 weeks difference in vol. this stuff moves so fast now because of the ETFs and because of the way that the ETFs work with one time frame selling and buying and their mandates, that determining that this level or this level will hold or not, I would never venture to say, right, at this point, because the volatility can go from where we don't have it, we're starting to see it, you're sitting there looking at it the way that you're looking at it right now, and it spikes and it holds, or it spikes and it does not hold and it just continues to run. And to me, there seems to be some good padding as far as levels are concerned, like HYG really sitting at a high level. The threatening levels are all really pretty clear as day, in my opinion. Like this really clear level, $83 on HYG is a very clear level. The flows are bad. The flows are borderline negative. It's been really burnt out. But this is being bid. If the Fed's not even going to blink at this stuff on a 10% correction, right? No, nobody's going to blink policy-wise on 10, 15% until these levels are threatened. They don't know these levels. Those are the levels where the cascading selling will kick in. And I think that that definitely aligns with the commodities. The commodities have been on a run. So are the commodities on just a counter trend, continuing declining move? Are the commodities on that kind of first wave move that then retraces, and then, you know, you get the real showstopper on a much bigger trend, right, overall? And is this, and that's why I propose in this conversation that maybe it's time to be thinking that the value in commodities environment may, not saying it will, I'm saying it may come to the forefront. And this is a year of pretty substantive transition overall, where those are going to run for a subset of years, and the equities run is not there. We've pulled a lot of growth forward in the market, in the equity side, a lot of forward. Is that continually sustainable grind higher? And to have to grind it higher without something just dramatic from a policy perspective to get that 7.25%, 7.5% target for the pensions. I think that all of it weaves together in my mind. And I think that we'll see. Like I would prefer to say that these specific levels that are about 10% to 20% in certain things, right underneath where we are right now, are kind of the tell for me. I don't know what that means to everybody else, but for me, that's where I would make some more intermediate to long-term allocation decisions at this point. And I would be
one of those
thinking
allocations you and I have both talked about is Ethereum. We'll end on that. Ethereum as a store of value, where do you see valuation, and why do you think it hasn't fired long like Bitcoin obviously kind of led that whole crypto craze? And a lot of coins are still moving, but in particular, Ethereum is just really triggering the last few weeks.
Ethereum's a protocol more so than Bitcoin. Bitcoin is more of a considered a store of value, I guess. I mean, I go back to, I'm not.
There's a lot of debate on that store of value.
I'm not the Bitcoin expert, again, for the 9,700th time. I've said I don't know it ins and outs, but like the Ethereum is much more of a functional type product building off of. I mean, there's a lot of ways that can go. Blockchain is innate to that that structure. Blockchain is innate to Bitcoin, but it's about the coin. I mean, it's just a transfer from me to you, or value to value.
Are you bullish Ethereum?
I am in the long run. I think it's
so
speculative right now. I would love to see it come back. I think that that's setting up a lot like the commodities charts. Like
that's why I bring it up.
Yeah, I think it's setting
it
up.
Looks it to me like when I mentioned
it looks like a cup and handle, right? It looks like a cup and handle. And
yeah, a few weeks ago when we did this, I mentioned Ethereum out of like, I hadn't even looked at it honestly, and I was just like, oh my god, this looks awesome. So yeah, it does not look done going up at all.
No, I think you know, I think Bitcoin is like now. Yeah, I mean, I will say it goes to, you know, people already made their money in Bitcoin. People bought Bitcoin 1,700.
As long as they can get it out.
1,500, whatever. You saw the guy who lost his
many.
Yeah.
It's heartbreaking. Oh my gosh.
You know, he's only got 2 attempts left, you know.
But and Goldman is coming in saying we're going to offer custody, you know.
That's the end of the cycle. That's not the beginning of the cycle.
That's the point, right? They're coming in saying, oh, we're going to help you out, those who can't remember their passwords from, you know, 2003. But the point is custody is coming in. That was regulations coming in. That's foregone conclusion. Ethereum still looks like it has a lot left. And it looks like a commodity play to me from just a technical standpoment, which is why I mentioned it a few weeks ago. But I wanted
totally.
to,
I think of the space, of that space, that's the value. That's the value play. It's got real value. It's not greater fool. It's not the higher, right? It's not the higher you know, price to be paid for somebody to actually take it off your hands.
Heinz is all over this. He's like, over 90% of all applications, it went away on me. And projects are using Ethereum because of their use case.
That's my point.
But how do you play it, Heinz? How do you actively, like, how do you express your trade in Ethereum?
There's two different ways to go about the space, the crypto space. Asset allocators that are in a bunch of different stuff in the space. It's one way to do it. And the other way to do it is just to go straight, get the stuff through. You know, Gemini has done a great job of becoming kind of a trading environment. Now I don't use it, but like they actively support it. You can do the grayscale stuff.
Not the Ethereum trust. It's terrible.
Those are coming along, right? I think you've got to pick, what was it? You look at the comparison. Yeah, you've got to look at the place that you want to park it, or if you want to actually go into the space and maybe give an asset allocator money to go put it in different crypto ventures. Those are the two things that I've seen people do successfully. I'm not one that's like, go get the, you know, a wallet and all that kind of stuff. That seems counterintuitive to me to being a store of value. Right. And I don't suggest that. I think there's got to be a better way to do that. I think that Ethereum has a lot of legs, a lot more legs than anything else in the space. So that's just my.
Well, they need to have some better trading vehicles for retail to really get on the bandwagon. The Ethereum trust is just not it. Link is exploding, Ethereum too. So look at their values.
Well, the problem, the problem with grayscale and stuff like that, like the problem is the custodianship of all these things, and then the float risk that they have on the cash. It's it's
still not a problem for the Bitcoin trust. They're #1 holders of Bitcoin on their balance sheet. And in fact, today they just came out and said, literally today, Grayscale buys another 16,000 Bitcoin worth another 590 million over the past 24 hours. Yep. Which equates to 18 times the daily Bitcoin, but it doesn't have the same weight as in other words, Ethereum doesn't have the same vehicle with that kind of balance sheet. So Bitcoin will wipe our known system. You got some strong opinions there.
Hey, look, people have their opinions about it, and that's rooted in the same store value thing that gold folks have been saying for a while, that they just don't believe that the currency structure is fitting, right? And so
I'm not going to go with the whole fiat.
I don't discard. I don't want to discard any of those opinions like that, because I think that they're fair opinions.
It'll be part of it. But I don't want to get into the whole Bitcoin Ethereum. I just want to know how you would express that particular play. We've talked about commodities, of which we both saw technically Ethereum looked like a really good one a few weeks ago. All right, totally. I think we covered everything and then some. Stagflation upon us, and we'll see what the policy regime looks like for actual fiscal policies, especially with Yellen at the helm of the Treasury, who is talking up Main Street over Wall Street, which is a big divergence. And now we have to see some in the market itself. And you and I are constantly looking at the market structure, the underlying breadth, et cetera, and option flow. And we're not seeing it yet, but we will talk about it. Maybe next week, we'll see something a little bit funky if we get some volatility into Friday, which is what I'm expecting. It might be short-lived, but something Wednesday to Friday, and then we'll see if anything really big character changes.
I'm looking for oscillation. That's
You're looking for oscillation. Okay.
I think oscillation upwards bent, oscillation in vol complex is what I think could potentially be coming through. And that would be kind of coincided with your indicator starting to show a divergence. So
That's what I'm
we'll see.
seeing.
We'll see.
And I do have one special announcement for anyone who is interested in the Thursday event, which is Women in Trading and Finance. We're going to have if I can bring her picture up, we're going to have a big name. I haven't tweeted this yet, but Tracy Shoot Chart, she is Chai Girl.
That's
She's got like 159,000 Twitter followers. She's a legend. She's a legend. She's a beast. Yeah. And we're not going to be talking about markets and energy per se, but obviously she's come from the floor, you know, and now she's independent consultant. And did I even share that? I did not. There it is. Sorry, this is Tracy. And I'll be tweeting that out, but also under guest captain interviews on my website. And then of course, YouTube trading channel, which James is making all spiffy and colorful, and I got my own channels now. He's working it.
There you go.
Anyway, so getting this good content out and up is part of the joy of running my own shop, and then of course just brain meld with you and getting your macro and micro take. This is very exciting. I like doing this Women in Trading and Finance side of it because I think we just need to. And it dovetails really well into this whole new regime change, if you will, of trying to bridge the gap in wealth and income inequality. So I'm doing my little part, and I know you're
Absolutely.
a total supporter of the cause. So
Absolutely.
Thank you, Jonathan, again. Thank you for joining us, and look forward to next Tuesday. In the meantime, have a great rest of the trading week.
Thank you, Samantha. Thank you, everybody.
Bye.